You know, we've all heard the gospel of value investing, right? Buy good companies at a fair price, do your homework, hold on for the long term. It sounds so smart, so responsible, but I'm here to tell you from my own experience as a financial professional that for most people, it's a beautifully disguised trap.
And this is really the heart of the matter. It's not that value investing is wrong as a theory. It's that actually doing it successfully requires a level of skill, information, and, well, just psychological toughness that very few of us actually have. It's a game where it is dangerously easy to overestimate your own abilities.
So, why do I call it an overestimation? Because value investing is just filled with these hidden traps that can catch even the smartest people. Let's break down the three biggest ones.
Okay, first off, real fundamental analysis, it's not just about looking up a PE ratio, that little number that compares a company's stock price to its earnings. No, it is a deeply specialized skill that takes years to get good at. Second, the numbers you're analyzing, they might not even be telling you the truth. And third, even if you nail the first two, the mental game, the psychological journey, can be absolutely brutal. Look, I'm a certified public accountant. I've spent my career swimming in financial statements. And even with all that background, I'm telling you right now, I don't believe I can perfectly analyze a company's true fundamental value. So if a professional feels that way, what chance does the average investor really have?
And that leads us right into that second trap, doesn't it? Your analysis is only as good as the data you're using. But in the real world, let's be honest, financial statements are often powdered, They're polished and tweaked to look a whole lot better than they really are. And sometimes they're just flat out fraudulent. So if you build this beautiful, complex analysis on a foundation of lies, what kind of result do you think you're going to get?
But okay, let's pretend you're a genius analyst, and you've somehow got access to perfect, clean data. The biggest trap of all is still waiting for you, your own brain. And there is no better way to show you what I mean than with a real-world test. Let's talk about the wild ride of Nvidia stock.
So picture this. It's late 2021. Your analysis is solid, you're confident, Nvidia is a great buy, so you get in around $30. And then you just have to watch it fall and fall and fall. By October of the next year, it hits $10. You are down almost 70%. Now be honest with yourself, really. Would you be doubting your analysis? Would your stomach be in knots? Could you really handle that kind of pain without hitting the panic button? Most people simply can't. Now let's say you do. Let's say you're one of the few who holds on through all that pain. The stock finally, mercifully, rallies back to the price you paid for it. What do you think most people do? They sell. They are just so relieved to get their money back, to be out of that stressful position. And then they have to watch from the sidelines as the stock just keeps soaring, leaving them in the dust. They're too psychologically scarred to even think about buying back in at a higher price. They were right all along, but they still missed the entire profit. See, this is the crucial point here. A company's value and its stock price, they are two completely different things. The price isn't just driven by fundamentals. It's driven by raw supply and demand, by fear, by greed, by mass psychology. There's a hidden language in the market that you'll never, ever find in an annual report. You find it by looking at the price chart itself.
To really see what I mean, let's look at the price action of a different stock. We'll just call it Special Case A. As I show you these numbers, just ask yourself this one simple question. Can a company's actual business, its real fundamental value, possibly change this violently, this fast?
I mean, just look at this insanity. All in about 6 months, the stock goes from 21 down to 6. Then it rockets up to 35, crashes back down to 14, and then surges all the way to a high of 74. So did the company's factories and products and management just get catastrophically worse and then miraculously better, then terrible again, then amazing, all in half a year? Of course not. This is the movement of capital. This is pure market psychology. This is something fundamental analysis just cannot explain or help you navigate.
And that's exactly where technical analysis comes in. Now, it's not some magic crystal ball that predicts the future. It's about understanding what's happening right now. It's the study of the price chart. That's just a picture of all the buying and selling, all the fear and greed. It gives you a way to manage your risk based on what the market is actually doing, not what some financial report says it should be doing.
Now, I want to share a personal story that really hammered this lesson home for me. It's a painful one, but it taught me everything I needed to know about the danger of trusting official news over what the chart is telling you.
So here's how it went down. I bought the stock feeling pretty good about my research. A few days later, bam,
trading is suddenly halted. I'm scrambling, checking the news, and there it is, a scary-sounding special treatment risk warning. It's basically an official red flag saying the company has financial problems. So the next day, the stock opens way down, and I do what any smart investor would do based on that news. I panic, I sell and take a big loss. And the very next day, the stock reversed and started a rally of more than 50% without me.
It was a brutal, expensive lesson. It hit me like a ton of bricks. That news wasn't meant to help me. It was a weapon, likely designed by the big players to scare the heck out of small investors like me so they could scoop up our shares for cheap right before the real move. The real story, the underlying strength, was right there on the chart the whole time, but I listened to the scary story instead.
And hey, this isn't just about single stocks. Think back to the huge market crash in 2015. At the very top, all the technical signals were flashing bright red. We saw a major divergence. That's when the price keeps inching up, but the momentum behind it is dying out. It's a classic warning sign. But as the market started to tank, what did we hear from official sources? Don't worry, we are rescuing the market. The people who believed that story got absolutely destroyed. The people who believed what the charts were showing them, they got out.
So this all brings us to the final verdict, the bottom line. When you're in the market, you're faced with two competing sources of information, and you have to decide which one you're going to trust.
On one side, you've got the news and the fundamentals. That's the story. It can sound really smart, really compelling, but it can also be delayed, manipulated, or just plain wrong. It tells you what the price should do in theory. And on the other side, you've got the chart, the price. That's reality. It is the final verdict of thousands of people voting with real money, in real time. It doesn't tell you what should happen, it shows you what is happening right now.
Ultimately, value investing asks you to be an expert analyst, an emotionless robot, and a blind believer in a story that might not even be true. Reading a chart, on the other hand, just asks you to believe what you see. So, the question I want to leave you with is this. In the market, what will you choose to believe? The story or the facts staring you right in the face on the chart?